Let's move on to Stuart now. Stuart had a couple questions, and Stuart made a comment at the end of the webinar, ladies and gentlemen. You get a little survey where you can answer a couple questions. And Stuart, I believe you sent a question related to the strategies, the normal progression of strategies for an investor. I was looking for that, and I couldn't find it. And I had a lot of coaching sessions on Thursday and got caught behind today. I was going to put something together for you, a little presentation. If we have time today, we might go through that a little bit more as well. But Stuart's question here, he says, question on covered calls. If you're adding the stock position for a covered call and stock is down, lowering the cost basis, you need to sell the covered call at the break even, correct? Break even as in the stock position, not where you picked up the new set of stock at the lower price. It's preferred, Stuart, absolutely, but sometimes it's not always available. I think coin was a big one recently that's had some rough patches, if I'm not mistaken. It's it's not as bad as I thought it was, but it's down again. Let me take a look at coin. It's not a recommendation or suggestion. Perfect. Not for anyone who's trading it, but perfect. And this thing was close to 180 a month ago. Right? Then it started to have a big decline down. It was at about 160 at the beginning of April. Let's go ahead and use that as our example. We're just say coin at 160, and it's now at 103. Okay, so let me close some of my windows here. The custom spread and COIN. We're going to add 100 shares at 160 towards the beginning of April. Now, I'm down 60 points. There's three things I'd normally look for in this situation. We'd evaluate a stock repair. I'm going to show that in a moment, Stuart. And if the stock repair isn't there, of course, we're going to evaluate selling calls continuously just to try to generate premium. I'm sure the volatility is high on this one. That's okay. But what Stuart's asking is, okay, right now we're in this position, and yeah, my break even's 160. And I can get $1. I can't even get $1 at 160. I'm at 60 to 95. I want to try to make up more of the $60 loss. And do I really want to sell something like a 117? Let's just call it the 120 at 5 points. And in general, in this case, the answer is, unless I had a strong sentiment that coin was going to stay below 120, and still expect volatile and choppy markets, but it's a possibility it could do that. But again, that's all dependent on, of course, we know something else. We're down 60 points. If we sell the 120 at 530 and the stock rockets up to 130, we can't react fast enough and we get assigned, we get locked in to a 22% loss, roughly 3,500. Hey, it's better than 6,000 that we're down right now, but we'd get the $20 back from the increase up to 120, or roughly 17, plus the 530. That knocks that 25, 26 off. So loss would be about 3,400, and we're locked into it. Now, there we go. What Stuart's saying is, now that I wanted to do this, but I need to average down, I'm going to add to a stock position to help average down the price. I'm going to put more capital in. This is sometimes very risky, but it's sometimes necessary to do if you've decided to hold on to the stock instead of get out of it and realize the loss. If you can't find any good premiums to sell, of course, against the position as well. So let's just do, 103. We'll call it 104. So let me see there. 264 divided by 2, I'm sorry. Okay, yeah. We'd average down to 132. So now I have 200 shares at 132. It would be preferred, and yes, I know I'm using such short time frames that there's not a lot of premium. We're just doing this as a quick exercise, Stuart. I'd prefer to be at 132, 133, 135 maybe, 230, 265, even though the stock's down that far. Could I sell, say, the 125? Sure, I could. Sell below it. I know I'm not going to get back to break even. What am I doing here? I'm taking the chance that the stock is still going to stay below 125. I want to get $4 instead of 220. Is it risky? Yes. If there's a sudden jump up on this position and it goes up to 128, 129, 130, then sure, I might be locked into 2.2% loss. Well, that's kind of better than the $2,800 loss per share or per 100 shares that I have right now with my new cost basis of 132. But it's helping lower the cost basis continually. I get 415. Hey, if I keep that 415, my cost base is now 128. It carries risk. We usually don't recommend it, as you mentioned, Stuart. We usually recommend that you want to sell the call above the cost basis in choppy and volatile markets. This is an extreme example. But again, coin can move dramatically, as you know. We've seen it in a constant downtrend, as well as some of the ARK-K ETFs and things of that nature. But it is volatile and it could snap back up. Again, outside forces as well. Now, it is recommended. Let's take a look. Let me take a look. We'll just go with the 135, 14 days out. Not going to be a lot of premium, but I'm still getting about $2 here to hedge the position, hedge the cost basis further, I should say. After I've added my new 100 shares, average down our cost basis on the stock to 132. Instead of collecting $4 at that lower strike, we're going to get about $2.50 at this higher strike. And if we are assigned, meaning the stock sees almost a 35% increase, then we'd still make about 4.2% on the position. And that's good because our break even now is 132. To get a desirable profit and loss chart that has a profit shown to the upside, Stuart, I completely agree with you that you should be selling calls, if possible, at the new break even cost after you've averaged down. So you don't see a position that could potentially be locked into a loss. In this example, we could say, yeah, it's not likely it's in the next 14 days, it's going to move up 20%, 30, 35%, but this is more volatile. So I'm going to agree with you that it's correct. I would want to sell a call above the new break even after I average down in price, Stuart, so I don't see the potential to get locked into a loss. But again, you want to analyze that position. Is the premium even worth it on your stock? If, say, I'm in a $30 stock that I bought at 42, I averaged down to 38, but right now the 39 or the 40 call is only 10, 15 cents. Is it worth it to sell that with a stock at 30? Is it worth it to sell the 35 and potentially get locked into a 3-point loss with my cost basis of 38 if I get assigned, or maybe 37, which is, close to 7% locked in loss? Maybe not, depending on the situation for the decline, how frequently your stock moves. And, if I'm at something like Kraft that I don't expect to move more than 1 or 2% over the next 10 to 15 days in either direction, maybe it's okay to take the chance to sell a call below it. But the type of volatile market that we're in, we could see more steep slides. If good news comes out, which we're all hoping for on any level, inflation starts to decrease, supply chains start to open back up again, lockdowns in China open back up to help the supply chains, and we see an end to what's going on in Eastern Europe, things might change dramatically to the upside, and you'd have to watch for that. And of course, don't ever sell a call as a covered call for repair, Stuart, below your cost basis if you have an earnings coming up between now and expiration, because that could cause a wild spike up and you might get locked in that loss or have to pay more to buy to close the position. Let's take our coin example in a different route. I had mentioned there, of course, that one thing I might like to do is a stock repair. So after we average down, we have a cost basis of 132. And if we sell these at, let's just call it 250, we'd have a break even, right, of 129.50 after adding more shares and averaging down in price. So either a break even of 132 or 129.50 after selling the covered call. And this is for shorter term, 14 days out. And you'd continue to roll it, treating it sort of like a calendar spread, rolling every cycle, whether it's monthly or every 10 to 15 days in that case. I put 160 in there, I'm sorry. So let's go to coin and let's go to the stock repair. Now, the stock repair tool tries to develop a ratio call spread against your position that might help you get back to break even faster. Now, the term ratio call spread might scare you, and of course, I'm not seeing anything available, so that's not a good example in this case. But this happens from time to time with too steep of a decline. Now, although the idea of a ratio spread might sound dangerous to you, a ratio call spread where I'm selling 2 calls and buying 1, where one of those calls that I'm selling would be naked and take a high risk and have a high margin, I already own the stock. So essentially, this is just doing a covered call against 100 shares of stock and then adding a bull call debit spread to it. So if the stock recovers, I get a little enhanced ramp up in profit. from the bull call debit spread and the regain in the stock. So let's say we did what you did with the covered call position. We averaged down to 132. We now have 200 shares of stock. Can I get a stock repair in the scenario? Not too bad. There's a June repair. Well, if I could sell May 20th covered calls and get a credit of 250, here I'm seeing a credit of 270. Why wouldn't I just sell the May call and then sell the other June call, get 250 each time, and I have it $5, and from 132 we'd lower our cost basis and our break even to 127. Look at the break even here. It's down to 114.65. Even though our new cost basis is 132, and we're collecting 270 of credit against this position, we're at a break even of 114.65. Stock only needs to move up about 12-14% or so to get back to break even. What is this? Let's take a look at repair details, and that gives us a breakdown of the stock repair. The system shows us we can buy two. We own 200 shares, so we're going to sell four and buy two. We can buy two June 100 calls for a price of $17.90. That's going to cost us $3,580. We're going to sell four June 115 calls, good 5-point spread, at $10.30. We're doing four of them, so we're going to let $4,120. So we're going to have a credit between those two of $540, or which works out to be $270 per share. Well, if my cost basis is 132, doesn't that make my break even 129.30? Where's this 114.65 coming from? I'm buying a 100 call, selling two 115s for a credit of 270. What happens when the stock's at 114.65? We're down 17.35 from our new effective cost per share, the 132 value. Okay, so we're down 17.35 from our cost basis of 132, excuse me. We bought the 100 call, and if the stock's at 114.65 at June expiration, we can sell to close those two calls for 14.65. And we keep the 270, which is 17.35. We've reached break even with only needing the stock to go up to 114.65. That's how the stock repair works, because this long call, as the stock recovers and starts to move back up, 105, 110, 115, we're getting the intrinsic gain, and we are essentially paid to own this long call by selling the others. Are these naked? Are two of these positions naked because we're selling four and buying two? No. Because we have 200 shares of stock. Two of the sold contracts, it's just a covered call against our 200 shares. And then here we have a bull call debit spread, buying two June 100s and selling two June 115s. It's not great, okay, but look at it this way. Sometimes you see a profit of 1, 2, or 3% here, Stuart, on the stock repair if it reaches the price. This one's very shallow. It's only 0.5%. And it's out to June. It's 42 days away. But think about this. The break even is at 114.65. I average down to a cost basis of 132. I would need to get $18 in call premium over the next cycles. We were seeing about 250, so let's call it 8 cycles to get that $18 to get the break even down to 114.65. If your sentiment is the stock's going to recover, this stock repair gets you potentially to break even faster. 42 days away, where I might have been able to only sell 2 or 3 calls at 250. Let's call it 750 on our cost basis of 132. So we're still at a break even of 124.50 roughly with the 750 we collected between now and June. If we're writing every 14 days, that would give us 3 write cycles, about 250. With this repair, we get a small credit that we saw of about 4 or 5 points, was it? That would lower the cost basis down. But now, because of the enhanced profit, the ramped up accelerating profit that we're seeing here from 100 up to 110, that's because we're gaining back on the stock and we're gaining on our extra long call. That's part of the bull call debit spread. And yes, if the stock moves above 115, we'd have the full profit on that bull call debit spread, and we'd be assigned on our covered call position. What we could do is just roll these 2 covered calls, close out the bull call debit spread for full profit if it's in the money at June expiration, And then the other two remaining calls, we want to stay in the stock that was down on us, that we averaged down, but now it's starting to recover. The market's looking stronger. We're more confident in the future of the market. We want to stay in the position. We could buy to close these calls and just roll them up to maybe the 120 or 125 for the July or for the August series. So to answer your question directly, Stuart, yes, in general, if you're trying to repair a declined stock position with covered calls, you don't really want to sell a call below the cost basis or the break even, or at least too far below it, because you can get locked into a loss if there's a sudden recovery. Even if you average down, you probably don't want to be selling too far below that new average down price. Because why? Because you don't want to get stuck in a position that gets you locked into a loss. But if you can't find the premium there, you may have to do that. If you can't find a good premium even at your new average down cost basis, you may have to do that. The stock repair, of course, is a great idea to look into, maybe after you've averaged down, because you might be able to get back to break even faster in a relatively short time frame if possible, without needing the stock to go up to 129, 127, or 125. Here we just need it to go back up to about 115, and we're back to break even from our original cost basis of 160 that we averaged down to 132 for. Of course, another suggestion I can make is that going forward in this volatile market, when you're opening new positions, maybe covered calls are not the best approach to use. Maybe you want to consider taking some information here about the married put position, buying stock and buying a put option far out in time for a longer term hold. Locks you into a guaranteed minimum loss of only 4, 5, or 6%. If you go into that married put tab here, you can take a look at the Learning Center. You can take a look at some of the articles, the covered call challenge and limited risk solution, the sketch there as well. And of course, you've heard me talk about the married puts, radioactive trading techniques, and the 12 different income methods various times if you've been following the YouTube channel or following our videos as well. In uncertain markets, the married put's been working out well for me. I had a fun little time the last couple of days. Wrong one. The Fusion subscribers at Radioactive Trading saw this. That pop-up that we saw on Wednesday morning, sort of the Tuesday night to Wednesday morning, we saw a little pop-up, and AIG got close to about 63, 63.15. And I was trying to sell the 65 call for May expiration 15, 16 days out in time for over $1. And the bid-ask spread was 105 to 95, and then it was 105 to 88. I put in my order at 105 and I didn't get filled in the morning before 10 a.m. Someone got filled at $1 because I was watching the price changes on the option research page. But then, of course, we all know what happened towards the end of the day. After the Fed announcement came out Wednesday, everything rocketed back up. So at about 3:15, 3:20, I was able to get filled at $1.20 for this call. And then, it went as high as a profit of 58%, I think, today with market activity. So I usually don't make trades that late in the day, but I missed it in the morning. And then the market started its reaction after the Fed announcement and the comments. It started to go up there on part of that roller coaster. So I was able to get filled in the afternoon at 120 that I wanted for this position. Been in it for 88 days, of course. It's a longer term hold position, but it keeps me out of trouble because this stock has been as low as $59. I think $58 if I'm not mistaken. But at that point, I only had a risk of about 2.5%. Then with a dividend that was received later and this other premium, the most I can lose on this position if it drops is 0.5%. If the stock goes up to this level here, make it 6.4% profit, but I'm going to continue to sell calls against it or make other adjustments following the rules that are discussed in the blueprint there that we talked about to control the risk and, of course, not worry about having to do a stock repair necessarily. I could still do the stock repair inside the married put position, but see all these risks, they're a little high now, but most of these are 6.5, 4.5, 7, and they're all 200, 160, 180 days out in time. That's what we prefer to do for the 3 core principles of the proper structure of the married put, and then we'll apply those 12 different income methods to lower that risk, enhance the potential return to the upside, and potentially bulletproof the trade where we have no risk on the position. So yeah, that information there, the married put, you can see some of that in the Learning Center, just some basic ideas and articles. The full course, of course, is the blueprint, which describes the proper setup in all 12 income methods. Standard collar positions are good to use in this kind of situation too, these types of markets. I have a couple of these open. 14, 20, 30 days out in time, a covered call solution instead of just buying the stock and selling the call and worried about a pullback. I'm still going to sell that call, but I'm going to use those proceeds to fund the purchase of an out of the money put, so I could still make maybe 1.5 to 2.5% if assigned to the upside. But if something happens and the market falls, I've controlled the risk to less than maybe 3% or 4%. And just like a covered call, I could continue to re-bracket the collar, like rolling down. The stock falls 10%, I'm only down 4. I could re-bracket the collar and still maybe have a 1% return here and only a 5% risk to the downside if I think it's going to recover. I don't have to necessarily take the 4% loss just because it's below the put strike price. There's other actions that you could do just as you can with a covered call, a cash secured naked put, or really any option strategy as well.